Hello everyone, welcome to TSAM Digital. My name's Amy and today I'm joined by Trisha Taneja, who's the Global Head of ESG for Capital Markets and Advisory at Deutsche Bank. So welcome, Trisha.
Hi, Amy. Thanks for having me.
Excellent. So I think before we get started, do you want to just tell us a little bit about your role, and then we'll dive into green, social and sustainable bonds?
Great. I head up ESG globally for Deutsche Bank's investment banking division, which is our core capital markets products, as well as M&A advisory. My role is to advise clients on how ESG impacts access to capital and how capital markets are changing in terms of their flow and their allocation of capital due to ESG considerations.
That's perfect. So in light of this then, can you just start out by defining green, social, sustainable bonds and kind of what sets them apart from the broad category of sustainable investments?
Of course. Green, social, and sustainable bonds are a particular type of ESG investment strategy. There's about 7 ESG investment strategies, and the ones that these use of proceeds instruments fall into is really thematic investing. And essentially, green, social, and sustainable bonds are debt instruments where the amount of proceeds that you raise, for example, you might raise 500 million, go towards environmentally or socially impactful projects. If it's environmentally impactful projects, it's a green bond. If it's socially, it's a social bond. If it's a mix of the two, it's a sustainability bond. And again, they fall under one type of investment strategy, which is thematic investing. The other unique thing about these bonds is that they do carry a lot of transparency, and the issuer typically discloses on the impact of the project's finance, where the proceeds are being utilized, as well as any governance requirements around how the proceeds are being managed. So they bring a lot of transparency to capital markets.
That's great. It sounds like a great area of thematic investing and very clear cut, as you say, nice and transparent. So sadly, not all areas are as transparent as this, and not all areas are integrating ESG very well. So on the other hand, could you tell us what product areas and financing may be lagging behind when it comes to ESG integration?
Yeah, that's a good question. I think recent regulatory developments in Europe have obviously made it important to think about all investments in all asset classes through an ESG lens. One of those lenses might be ESG integration, which is really looking at integrating ESG data into your valuation processes and your investment decision making. I think that's easiest for public equities. It's a little bit more challenging for fixed income. But I think where it's most challenging is really multi-asset funds, sovereign debt funds as well, because it's not always that easy to analyze sovereign ESG performance, or what are the ESG areas of risk for sovereigns. And then, of course, private funds, including private debt funds, right, where it's not always easy to get ESG data from private companies. So I don't think it's for lack of trying. I think it's just a data and methodology challenge that I feel confident the market will overcome.
That makes sense. And yeah, in light of the regulation, I can imagine everyone's kind of honing in on this issue more. But given that some will be ahead of it than others, what steps are you taking to increase client dialogue on ESG, as well as spread ESG knowledge?
Absolutely. One of the recent stats that I read in a report was that 72% of asset managers are planning to stop fund distribution if it doesn't meet Article 8 requirements, which is minimum ESG sort of requirements as per European regulation. So I think what we're really focused on is channeling investor feedback back to our issuer clients. What are investors looking for on ESG? And we're pretty proactive about going out and speaking to the buy side, understanding what their requirements are, whether it's ESG data or more engagement, more types of green or sustainable bonds, and then making sure we're delivering that investable universe to them, and really channeling those requirements back to our issuers. So that's a really big priority for us.
Okay, you mentioned a few of those trends there. Are there any other key themes that are coming from that feedback then?
It's interesting. I think one of the things that I'm hearing from investors and asset managers is that all new capital being raised is being channeled towards ESG type products. There's an increased demand for impact products, particularly those that are Article 9 aligned. There's obviously an increased demand for products that are transparent and aligned with the EU taxonomy. So really, very transparent about what the definition of green is and how it aligns with the European regulation. And I think those are some of the key trends. So really exciting time for European capital markets, I think, because there's definitely a shift coming with respect to the amount of capital that's tied to ESG type products.
Yeah, absolutely. I think defining those terms, following the regulation will be a good starting point. But to focus on your area then, so what is the key for leveraged finance specifically to accelerate their climate transition and integrate ESG into their investment strategies?
Yeah, I think leveraged finance, which is essentially leveraged loans issued by private equity held companies, has been a really big growth market for ESG. It's particularly over the last year. And I think that, what a lot of private equity firms and sponsors are starting to realize is that you cannot exit an investment particularly into European public markets, if it doesn't meet sort of minimum ESG requirements, or if it doesn't have ESG data and disclosure. And so that exit preparedness is what's really driving private equity firms to make sure their portfolio companies have ESG data that's then tied into their leverage finance, right? So that's sort of what's been driving the market. I think one of the big challenges for this market is to maintain integrity and really make sure that the KPI is being used or meaningful and ambitious and are really truly preparing the company for an exit. And I think that the industry has made massive strides within just a year to bring out, guidance around what type of KPIs are ambitious material for what companies. And the European Leveraged Finance Association in particular has done a lot around this. So really positive steps to ensure that, again, the market is moving in the right direction, which is growth with integrity.
That's really great to hear. And you mentioned a few of the motivators there, for asset managers. So I'm keen to talk about, the innovation that can help them get there. So for example, when we talk about data analytics, are there any trends that you're seeing when it comes to using that and leveraging that for ESG to help firms get there?
Yeah, I think that one of the biggest challenges is the lack of standardized data and metrics. I think that there's a lot of initiatives, including the ESG data convergence project in private equity, that are helping to standardize this, including ISSB in public markets. But I think where technology and AI has a role to play is really aggregating standardized disclosures into comparable metrics. So I really see it as an important tool, both for private markets and for ESG rating agencies, in order to develop particularly predictive or forward-looking type of ESG scores based on past performance.
That's fantastic. So closing thoughts then, what are your kind of hopes for the future of the industry?
Growth with integrity about sums it up right. So that would be my hope for the industry.
Well, we'll see. I mean, we've got our TSAM ESG conference coming up on the 2nd of November, so I'm really excited to discuss a lot of these themes further, and we'll see where we are by then. But until then, I think that's all we've got time for today. So thanks so much for joining us. It's been great having you.
Great. Thank you.